Index funds and hedge funds are both investment strategies, but they serve different types of investors with different goals. Choosing the right one depends on risk tolerance, investment strategy, and accessibility. An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to track a specific market index, such as the S&P 500. It passively follows the performance of a set group of stocks or bonds, meaning it doesn't require active management. Index funds are known for their low fees, broad diversification, and long-term growth potential. They're best for average investors looking for a simple, low-cost way to invest in the stock market with minimal risk. However, index funds only provide market returns, so they won't outperform the index they track. A hedge fund, on the other hand, is a high-risk, actively managed investment fund designed for wealthy investors and institutions. Hedge funds use complex strategies, including short selling, leverage, and derivatives, to try to beat the market and generate high returns. Unlike index funds, hedge funds are exclusive, requiring high minimum investments and often charging hefty fees. While they have the potential for big gains, they also come with significant risks. Hedge funds are best for experienced investors who can afford to take risks for potentially higher rewards. Now, let's compare them side by side. First, management style. Index funds are passively managed, meaning they follow an index without frequent trading. Hedge funds are actively managed, with professional investors making strategic decisions. If you want a simple, hands-off investment, index funds are better. If you prefer active management, hedge funds win. Next, let's talk about risk. Index funds have lower risk because they spread investments across many stocks or bonds, reducing volatility. Hedge funds are riskier because they use aggressive strategies to maximize returns. If you want a safer, steady investment, index funds are the better choice. If you're willing to take high risks for potential big rewards, hedge funds might work. What about fees? Index funds have low expense ratios, often below 1%, making them cost-effective. Hedge funds charge high management and performance fees, sometimes taking 20% of profits. If you want a low-cost investment, index funds win. Now, let's consider accessibility. Anyone can invest in index funds with a small amount of money through brokerage accounts. Hedge funds are restricted to accredited investors with high net worth and require large minimum investments. If you want an easy-to-access investment, index funds are the better option. Finally, let's talk about long-term growth. Index funds provide steady, market-matching returns over time, making them great for retirement savings. Hedge funds aim for high short-term gains, but can be unpredictable. If you want reliable long-term growth, index funds win. So which one is the better choice? If you want a low-cost, low-risk, long-term investment strategy, index funds are the best option. But if you have a high net worth, can handle risk, and want aggressive, potentially high returns, hedge funds are the smarter choice. The best investment depends on your financial goals, risk tolerance, and access to capital.